this weekend, my wife and I went to the movies to see this new Peaky Blinders movie. And we were long avid followers of Peaky Blinders on Netflix. This is a saga, if you don't know, about a group of gangsters that were headquartered in Birmingham, England. So Birmingham is about an hour or so north of London. By my watch, I've been to Birmingham, but it's been long ago. This whole cast, this whole set was taken all the way back into the 1920s, and it actually started prior to the 1920s. It was between World War I and World War II. It included the Roaring Twenties, and it also included the crash of 1929. So I'm sitting here watching this movie, and here I am. I start thinking about the stock market. This was last night, and I'm looking at the time frame. I'm thinking about the time frame then compared to today, and I find it's fascinating how much the Roaring Twenties and the 2020s mirror each other because, what's it that Mark Twain said? He said that history doesn't often repeat, but it often rhymes. And so thinking about that and thinking about those 2 decades, both had a global pandemic when they started. I don't know if you noticed, but back in 1918, it was the Spanish flu. In COVID, it was in 2020/2019. That both of those led up to what's called pent-up demand. It had an explosion in the stock markets and it reshaped the stock market. So I want to talk about, first of all, key similarities. So key similarities are what's the if you were to transparent layer them on top of each other, what were the key issues then and now? Well, you got technology, all right, and what we call moonshots. And technology moonshots then, in both eras, investors fell in love with technology. And of course, those technologies led to massive bubbles. So in the 1920s, put yourself back in the 1920s if you can for a moment. This was the age of radio, it was the age of cars, and it was the age of electricity. All of this coming together at one time. And so the big stock back then, the big company back then was RCA, which stood for Radio Corporation of America. Imagine this was the NVIDIA of its day. So, sitting here, being able to hear a broadcast wirelessly from one point to another point. Fast forward to today, it's artificial intelligence, it's electric vehicles, and a market that's been driven by a small group of tech giants. So then you got number 2, which is the rise of retail. Now, both decades saw retail trading, and that could be for better or for worse, depending on who you were. And in the 20s and the 1920s, that was the first time regular people started buying stocks. There were ticker tapes in barbershops, grocery stores, lounges. I mean, you could track the markets from anywhere. And also a big thing was margin back then. They had 10-to-1 margin in a lot of cases. Now, fast forward to today, you got Robinhood, you got meme stocks, GameStop, AMC. This turned trading into a social media event. And of course, we had, if you remember, stimulus checks, which helped stimulate the rise of retail trading once again. Now, margin is a lot more regulated today than it was back then. But when you add on things like zero-day options, which I am not a fan of, I see a lot of people out there promoting and pushing zero-day options. To me, that's like a lottery ticket. Now, the other thing that's big in margin is this highly leveraged alt crypto trading, right? That's created kind of a similar fever that was had back in the 1920s. And then number 3, you've got rapid recovery and easy money. Now, both decades saw a period of government intervention, but they also saw a period of low interest rates. So in the 20s, the Fed kept rates low for much of the decade, and that fueled that credit boom, and it allowed the economy to roar after World War I, after the recession of World War I. In the 20s, well, we all know what happened. COVID created stimulus packages and near zero interest rates. Remember those famous words that were uttered? I'm not even thinking about raising rates. All right, that's what Chairman Powell said. That sent asset prices, stocks, housing, crypto to record highs. So take a look at this. This is a key comparison table that I put together on this information. So, you've got here, the first column says feature. The second column as I blow it up, shows you what happened in the 20s and the 1920s and the 2020s. So you've got, the hype was the radio back in the 20s, artificial intelligence today, the trading hub, ticker tapes, social clubs, speakeasies. Now it's Reddit, TikTok, Robinhood, the speculative asset. Back then was Florida real estate, of all things. And of course, today it's cryptocurrency, NFTs, and zero dated options. And the preceding crisis, if you remember, that caused all of this. Well, back then it was World War I and the Spanish flu. And of course, not even 6 years ago, it was COVID-19, the pandemic that ensued from COVID-19. So we all know what happened after the 1920s, and that was the stock market crash, okay? The great crash of 2029. But again, now we've got modern markets, we've got guardrails, we've got circuit breakers, we've got things to slow down a huge crash like what happened back then. But the human emotions, greed and fear, they're literally identical between then and now. So now we got to think about interest rates and the Fed. So to understand, whether we're heading to a 1929 style landing, we got to look at the Federal Reserve. And it was a very different situation a century ago. So if you look at then versus now, then we had the gold standard. You got to look at gold versus fiat. So in the 1920s, gold standard. Fed was required to back its currency with gold. So that meant they couldn't just print money, and especially if they were trying to save a failing market. And so physical gold had to back up any money. When the crash happened, well, the government was pretty much handcuffed. Now, fast forward to today, we've got the fiat system, which means we can create liquidity out of thin air. And in 2020, they injected trillions of dollars in the system within weeks. Now, that prevented a total collapse, but it created a different problem. And we all know what that problem was: inflation. So if you look at, for instance, the rate policy, which is, we call it then versus now, back then, the Fed actually raised rates. So we know this. We know the Fed raised rates in 1929 after the market started to wobble because they were protecting gold and they were also worried about speculation. So that was what ended up happening. And what they thought was going to occur and what did was something different because they actually choked the economy this way. Now we've learned from that mistake. And the 2020s, the Fed's playbook is basically the opposite. They're saying lower rates for longer, and it creates more of a softer landing and maybe more of a recovery approach. So the big question we have on our minds, and you should have on your minds right now, is this one: are we headed for a 1929 style bubble? Now, most people out there, if you talk to them, most economists think it's unlikely. And more likely, we're going to see something called stagflation or a stagflationary grind. All right. But let's look at what often rhymed, okay, if not repeated. So these are what we call the danger tables. And this is 1929 versus 2026 today. And so when you take a look at the danger tables that are out there, you've got the 29 bubble, that was electricity, radio, and then we've got our frothy moment right now, which is AI, and the danger level is considered high when you look at the fundamentals behind it. And the reason why is because you think about it, we're gearing up for all this AI moment, and perhaps the stocks, the companies behind those, aren't ready to give us the profits yet because they got to invest a lot of money into this moment. Retail behavior is similar today. You got margin buying at barbershops back then. You got zero-day options on apps today. Company health. Back then, RCA didn't even have any money. All right. They weren't making money. They were just a thing, and everyone was all hyped up on what we called the transformative profits. So there's that. Right now, all the AI leaders are cash rich, but that may change very quickly as they have to put together the money to pay for the infrastructures. And of course, valuations, back then RCA was just absolutely insane. It was just, to give you an idea, the stock went from $11 a share back then to $114 in a year. They never even paid a dividend. And so the reality is that you look at the hyperscalers, Nvidia, and the following, they all had the similar path. And so that's the thing when you look at these danger tables that are out there. So there are some very high danger levels, and then there are some valuations which are really considered moderate. So as we move forward and you take a look at everything, we talk about before where we looked at the 10-year cycle. And while the outlook going forward, we're still, less than halfway through this decade. And so, even with things like Bitcoin seen as digital gold. You've got altcoins that are considered or an area too that you got to worry about. You've got market concentration where you have a handful of stocks like the Mag 7 or whatever we're calling it this week. Those could be if one or two of those fall, it could cause the overall market to drop. As they own about roughly 35% of the S&P 500. But if we were to compare those all together, you still have a half a decade, like I just said, before we see this whole thing play out.